The British are coming! No, not those. The British are coming! No, not those. The British are coming!
No. 1 ounce silver Britannia coins from the Royal Mint at only $2.99 over spot. Spot. It makes me want tea.
Yep, that's them. 1 ounce silver Britannia coins are only $2.99 over spot, now through Sunday, June 28th, 11:59 p.m. Eastern Time. Email libertyandfinance@protonmail.com and include your phone number for faster response.
Hey everyone, if you haven't already made plans to attend Freedom Fest 2020 at Caesars Palace in Las Vegas, Nevada this July 13th through 16th, you're going to be missing out because I'm going to be there, as is Doug Casey, and a host of other speakers. You're going to meet lots of freedom lovers at Freedom Fest 2020, including speakers like John Amash, the House of Representatives, Doug Casey, George Gilder, futurist, Mike Lee from the U.S. Senate. We've got Stephen Moore from the Heritage Foundation, Rand Paul from the U.S. Senate, and many more speakers, Donald Trump Jr. You'll see me at the Miles Franklin booth, but I'd like to see you there, and if you want to get there at a discount, check out in the description of this video, and you'll see a discount code that'll get you $75 off an admission at Freedom Fest 2020 this July 13th through 16th in Las Vegas, Nevada, Caesars Palace. See you there. Welcome back to Liberty and Finance and Reluctant Preppers. We have the returning guest, Rick Rule, the CEO of Sprott Asset Management, returns to us this Friday, June 26, 2020. Rick, thanks for joining us again.
Always a pleasure, Dunnigan. Thank you for arranging this.
As always, ahead of your arrival, our viewers have submitted copious questions that we'd like to pose some of to you. We won't have time to get to all of them, but first, we'd like to talk with you about your perspectives on the overall market dynamics that are affecting not only the precious metals markets, but also the precious metals mining equities. And you've been observing some interesting capital flows into the mining sector, and your experience over decades has given you some seasoned perspectives on what's likely to occur when we've been seeing this strong inflow of capital into the mining sector. Could you talk to us about what your perspective is on that at this time?
Thanks for this opportunity, Dunnigan. The last 4 to 6 weeks has seen a wall of money coming into the junior mining sector, particularly with regards to financings. Companies that couldn't get financed 6 months ago go out to raise $10 million, get oversubscribed in 45 minutes, and go home with $14 million. Well, this gets everyone from brokers who get the commissions to speculators to company managers excited. It is one indication of a market that in the very near term may be overheated. Dunnigan, in these interviews, we frequently refer to the Barron's Gold Mining Index, and we've sent thousands of them to your subscribers. If you look at the 8 recoveries that this market has seen over the last 45 years from oversold bottoms, you see dramatic escalations in share prices. But what you see when you look at those recoveries is fairly frequent circumstances where in a bull market, there's a pause, where there's a 10% reset, a 15% reset, a 20% reset. And my suspicion is in the very near term, we're probably due for a little bit of an air pocket in the junior mining market. The market has given us too much too quickly. There has literally been a wall of money coming into the sector. And it may be, this is not a forecast, but it may be that the general securities market is due for a bit of a rest too. The reason given for the extraordinary performance on Wall Street, at least relative to Main Street, was of course perceptions of a rebound from the COVID virus. It's pretty clear around the country, particularly here in California, that we are not recovering from the increase in infection that we had hoped to be. And in fact, yesterday we had the largest recorded incidence of new cases since we have been keeping track of that. I'm afraid that a combination of a reemergence of fears with regards to the virus, a very soft general economy, and perhaps an overheated general equities market will give us a bit of a pause, a bit of a decline, or maybe something more dramatic in the broader equities markets. Normally, when that happens in the very near term, that's reflected in mining stock markets. One needs to realize that gold stocks are stocks, and if the stocks go down, the gold stocks will, in the near term, be affected. The likely policy response to that, of course, quantitative easing, artificially low interest rates, all that kind of stuff, are ultimately good for gold and the gold equities. But I think that your viewers need to refresh their memory of that chart, and they need to prepare themselves for 3 or 4 character building circumstances where the broad junior indexes sell off by 10% or 15% or 20%. These backing and filling maneuvers are normal, natural, and healthy in the market. And the truth is, if you look at that Barron's Gold Mining Index chart, when you look at one of these recoveries, trough to peak, the recoveries are so dramatic that unless you look, you don't see the declines. But that's on a historic basis. When you live through one, it can be character building. So all I'm trying to say is don't give up. Understand that we're probably in for a 2 or 3 year bull market, but we're going to be challenged along the way. And I suspect we're going to be challenged fairly shortly.
You know, you mentioned those policy responses that affect the gold and thereby the gold stocks. But interestingly, those same policy responses often involve buoying up the equity markets in general. So it's like the mining stocks potentially could get a double whammy benefit from the policy response.
The one policy response that I don't think will benefit the gold stocks is direct buying of debt and equities by the Treasury. I suspect that Mr. Trump will not ask the Fed to buy the TSXV Junior Resource Index with federal funds. The rest of the policy response that you talk about, other than direct Fed buying of assets, certainly would benefit gold and ultimately the gold stocks.
Since you brought it up, talking about our viewers who have submitted portfolios to you for your review and comments, who have received that premium that you've given them. Tell us again about what these premiums are that you offer to people. But I've got to tell you that we've got some fairly pointed questions from people who feel that they've been trying to be quite patient about waiting for the replies to some of their stock rankings. So if you could first tell us what the offer is and what people can receive in return for that, and then we can talk about what they should realistically expect in terms of a turnaround time.
Well, let's do that right now. The offer is 2 charts. One, the Barron's Gold Mining Index. I use the Barron's Gold Mining Index because it's a very broad index and because it covers the longest period of time of any chart that I could obtain. And I wanted to show the gold market going all the way back to, say, 1970. The good, the bad, and the ugly, if you will, of the gold equities indexes. So I'll include that chart and a 100-year commodity chart that talks about the relative valuations of commodities as against other parts of the economy going back 100 years. The centerpiece of the offer is that I personally will rank your listeners' natural resource equities portfolios. If they go to a web link, which is sprottusa.com/rankings, and input their natural resource portfolios, both names and symbols in the text, not as attachments, please, I will personally rank your holdings and comment on those companies where I think my comments are of value. Here's the caveat. We update, we meaning Sprott, but myself as the bottom line, update those rankings continually, which is occupying 6 or 8 hours per week. At the same time that we are receiving literally thousands of requests for rankings. We've received over 8,500 ranking requests this calendar year. The consequence of that is that I and my team are approximately 1,000, that's 1,000 ranking requests late. Understand that when you get your rankings, that the stocks will be updated to the most recent ranking information that we have. In other words, you won't get stale dated information. But understand, too, that I won't be able to get it back as quickly to your listeners as they're able to get them to me. There are simply more of them than there are of me.
And that's understandable. There is one clarification that one viewer asks us to remind people of, that there's no cost to requesting this review. You do need to be patient, so it'll cost you patience. But that also people are expressing an interest in the natural resources sector, so they are likely to be contacted by Sprott to ask them what their needs are in that space as well.
We do that. What I do is I look at the questions that are asked by the questioner and the stocks that he or she has in their portfolio, and I introduce them to somebody at Sprott who, assuming that they're interested in Sprott products or services, or interested in a more in-depth discussion of the companies in their portfolio, that they can communicate with. Although I would like to, I simply can't communicate on an efficient basis with 8,500 people.
Understood. And there's one more clarification that I think you've talked about this, but it's been a long time, and so this viewer and maybe many others have the follow-on question. Sharktooth Diver says, I've appreciated Rick allowing me to send him my list of resource stocks to rank from 1 to 10. I've done it twice, adding additional mining stocks to the first in an effort to find better choices, but I've never seen Rick give a ranking above a 4. Even with Newmont and Barrick only getting a 4 ranking, would you please ask Rick to name just one stock with a 1, 2, or 3 ranking and explain why is it that it's so rare for you to rank stocks above a 4?
Given the fairly rapid escalation that we've seen in gold mining stocks, I don't have any 1s or 2s on a valuation basis at all. I have a handful.
You can clarify what it would take in your book to rate a 1 or 2.
Yeah, let's talk about a 1. The last 1 I had in the book was Ivanhoe Mines 5 years ago, when it was selling for 63 cents a share and had 90 cents a share cash in it. In other words, a company fronted by the best natural resources promoter in my lifetime, with 2 world-class deposits in one company, joint ventured with the government of Japan in one project and the government of China in the other project, selling at a 35% discount to net working capital. A 1 means that I believe that the company is selling for less than half what it could be liquidated for on the day that it's called into question. I need to be able to see a catalyst other than valuation, which could double the stock within the 18-month time frame. I need tier 1 management, I need a tier 1 deposit, and I need to see a way, it doesn't have to happen, but I need to see a way that the stock could go 10 for 1 within 5 years. I believe that I have given out 8 or 9 1 rankings in 35 years of ranking stocks. They're extremely rare. I'm delighted to say that after I bestowed that 1 ranking on Ivanhoe, it took a romp from 63 cents to $4.75 in 15 or 16 months. It was a wonderful romp. And of course, romped itself out of number 1, out of number 2, and out of number 3 as a consequence of the fact that my price expectations were met.
Right. We've got a question here from Ben Wolf, who says he's been having the same question for some time now, but hasn't been able to get a reply from others, so we'll try it with you. He says, Harry Dent claims that gold will drop to around $700 an ounce because all assets are in a bubble, and therefore gold must drop, even if it will drop not as much as other assets. And it goes on, and then it finally says, basically, where is a safe place for one to keep cash for the time when one wants to buy assets, assuming one wants to buy assets in a basically a Mad Max world. So my question for you is, what's your take on Harry Dent's theories?
I like Harry. I think he's a very interesting thinker, and I understand his concern about the fact that liquidating debt on a global basis is extremely deflationary. And if the big thinkers were to lose the confidence of voters and shareholders, we could, in fact, face deflationary pressures. My belief is that the policy response to the specter of deflation is ultimately inflationary. My suspicion is that we have at least one more round of the 1970s in us, a circumstance where we create specious currency units, much to the applause, by the way, of the electorate, and we are able, as a consequence of that, to forestall a reckoning, a deflationary reckoning, and kick off what I think is likely to be stagflation. But people should pay attention to what Harry has to say. Just because I say it certainly doesn't make it true. The second part of the question, in terms of where you store your money, I think it's important that people maintain some US dollar liquidity. It is true that your savings denominated in US dollars will cost you purchasing power every year. That's absolutely true. Artificially low interest rates means they're not going to compensate you for deferred consumption. They're going to penalize you, but you have to do it anyway. Having cash gives you the tools and the courage to take advantage of volatility and illiquidity rather than being taken advantage of. It is absolutely critical that people keep this in mind. There are several deposit-taking institutions in the United States, which is a long way of saying banks, that are old-fashioned in the sense that they have money in them. One is Farmers and Merchants Bank of Long Beach, where equity is about 20% of primary capital. The Fed, by the way, suggests that 7% is well capitalized.
Yeah, and recently they removed any requirements around that, right?
Right. So I would suggest that your readers look for information surrounding well-capitalized banks and store cash in those well-capitalized banks. I do believe that the Federal Reserve will do their best to bail out defaulting banks. But if something happened at your bank, you might not have access to your money for 3 or 4 months, which means that you've encumbered yourself with a lot of uncertainty and you've paid an opportunity cost when you've been prudent enough to put in place the methods to take advantage of that volatility. So put your money in liquid fashion in very, very, very well capitalized banks.
Speaking of confidence or lack thereof in the dollar or in banks, Edward Leroy asks, will loss of trust and confidence in the dollar come from other countries first or from the public/common people first?
That's a great question, and I suspect it'll come from the United States. I'm amused that Doug Casey has said that our strength isn't so much absolute strength, but relative strength. In other words, as bad as we've screwed up this place, the Europeans have screwed up Europe worse. The Japanese have screwed up Japan worse. Doug describes the U.S. dollar as, quote, the prettiest mare at the slaughterhouse. I remember a discussion that I personally had with an official at a very large Asian sovereign wealth fund. And I asked him about the value proposition associated with U.S. Treasuries, the fact that he was being paid less in interest than he was being penalized by the devaluation of the dollar. And he said, given my alternatives, U.S. dollar-denominated Treasury securities are my best opportunity. I went on to say, do you trust us? And he says, oh, no, but we trust you more than we trust each other.
That's a corollary to your first postulate there.
Yeah,
Okay.
it was a very interesting circumstance.
What a sad state of affairs.
There is a lot of strength and there is a lot of ingenuity left in U.S. society. I'm not passing judgment now on our political apparatus. I'm passing judgment on your listeners and viewers who are, by and large, at least in terms of my interaction with them, fine people. And we are still a country where, 5 or 6 kids get together in a garage in Sunnyvale and out pops Facebook or Google or something like that. There's still a lot to like about this economy. It's just that we have allowed ourselves to get spoiled. And we do face a reckoning, I believe.
There's a follow-up question from the same questioner talking about loss of confidence in the dollar wherever it comes from. Can either source have the effect of causing the crash of the world economy / monetary system and the reset of the dollar?
If somebody asks me, is it possible, I have to default to yes, because many circumstances have come true that I didn't think would or could come true. The fact is that there's no certainty in life, Donegan, as far as I'm concerned. There's a range of probabilities. And I think the prudent speculator pays attention to the probabilities and positions him or herself according to the probabilities as they see them, with a margin for error. So, yes, maintain U.S. dollar liquidity. Yes, maintain bullion as liquidity too. If you can afford to invest after you've saved, certainly buy some of the gold equities. To the extent that you see the U.S. equities broadly lower and you have the ability to buy fractional ownership, which is to say shares, of some of the best businesses in the world, do that too. Remember that there are no certainties. There are merely a range of probabilities. So pay attention to the probabilities and pay attention to the amount of risk that you yourself can afford, both financially and psychologically.
As long as you're mentioning things that there are no guarantees, the old saying that there's only death and taxes, that reminds me of several people that I've spoken with recently have talked about anticipating with the dilution of the currency, this easy money expansion of our currency supply that's been going on, anticipating that we should look towards higher taxes in the future. Just a question. People who have like current IRA accounts and are thinking, gee, when should I take a distribution or convert this to a Roth IRA and go ahead and just bite the bullet now and pay my taxes now versus defer my taxes to some point in the future and have to pay it then. If people are looking at the policy responses we've been describing that are being taken at a scale they've never been done before, do you think it's realistic to expect that individual income tax rates will rise in the future out of necessity, and that people might want to consider biting the bullet now and paying taxes now, rather than thinking that by deferring them they're going to benefit to some future time?
The second part of the question, which is what individuals should do, involves giving individual investment advice. And I don't want to do that unless I know the questioner very well. I've been tempted to do that in the past, which is stupid. The prior question, however, is, will taxes go up? That's as close to a certainty as anything I know. I guess I have to describe it as a probability, but I'm tempted to say it's a certainty. I live, as you know, in the People's Republic of California, and there's lots of demand for tax fairness in California. The top 1% of taxpayers in California pay 42% of the income into capital gains tax. So in terms of tax fairness, one might ask when the 1% will get their rebates. That won't occur, of course. With almost 50% of the voters paying very little in tax and 1% of the voters paying half the tax, it's fairly certain that an election in California will be the one paraphrased on an old libertarian pin about an election being 4 coyotes and a lamb voting on what's for lunch. Your listeners are going to be lunch in any circumstance. Taxes, particularly on upper income earners and on capital gains, that is to say investment income and passive income, will almost certainly be higher.
This is a follow-up question. You've already addressed part of this, but I think there's a twist on it, so I think we should address it as well. Terry Butner says, it's a pleasure always to listen to you speak. In the past, you have said, keep cash, keep your powder dry, wait for a good downturn for a contrarian opportunity. Is this presently the same? I think you've already addressed that. But how should we recognize when the market has turned down sufficiently to re-enter?
For myself, it's my level of terror. When I have to force myself to do something, it's usually smart to do it. I'd rather defer to Warren Buffett's answer to the question, which is to say, you don't know except that you know. He points out that in the 50 some odd years that he has been the steward of Berkshire Hathaway, that Berkshire Hathaway stock has declined by 50% or more in 18 months. Now, if you look at a chart of Berkshire Hathaway from the mid-60s till today, you can't see those 50% declines. But living through them was extremely, extremely unpleasant. In the great gold bull market between 1970 and 1981, I remember well, the gold price had gone from $35 an ounce to $200 an ounce by the end of 1974, attracting a lot of attention. People liked it more in 200 than they had at 35. And then the price fell from 200 to 100. And those newfound gold bulls had their faith very, very, very tested. I don't know the answer in terms of your questioner's psyche or experience, but I would suggest that reading a couple of the books that I've described on this program before, Economics in One Lesson and The Intelligent Investor, would probably frame the question well for the questioner and allow he or she to engage in more rational behavior in future declines.
There's a related question here. Ag Kings said, some of us have been waiting for silver to make a significant move for over a decade now. Our hair is starting to turn silver in color. It's getting quite frustrating, sitting on a pile of metal not doing anything. Even though one doesn't like to predict time frames, which is understandable, what would you say to an investor who bought at around $40 to $50 in 1980 and 2011?
Well, the first thing I would do is if you have a big built-in tax loss, take it. The idea that you could sell some $40 silver now, recognize the loss, wait 31 days, and buy it back at $17 or $18 means that you have locked in a substantial tax loss carry forward, which could be of benefit to you. We ruefully call this the penny stock dividend, which is to say that if you have a large realized loss, the smartest thing that you can do is realize it and pay less tax.
Hey, if you ever retire from Sprott, Rick, you can definitely have a job at the national government, at federal government, making up acronyms for things that sound really good when they're horrible. Yeah.
The truth is, if I did stand-up comedy, there's an audience of about 7, yourself included, who would like me.
That is not true. I didn't mean to interrupt you. You were on a roll. I just couldn't resist that.
I just think, the first thing I would do if I had a lot of inventory of silver at $40 is I'd sell it. And I'd take the tax loss. And then I'd wait 31 days and I'd buy it back. And depending on the size hoard that the gentleman describes, he might not pay tax this year and next year. In fact, if my memory serves me correctly, and at age 67, it probably doesn't, I think that he can deduct $3,000 of the loss from this year's income.
That's right.
The idea that you pay less and pay them later is both efficient and patriotic from my point of view. So that's where I would start. Asking the guy psychological question, which is to say, when is the market going to kiss me and make me feel better? I don't know the answer to that, but I suspect that the answer or the probabilities are in that Barron's Gold Mining Index chart. The circumstance that the gentleman describes, which is to say that he bought that silver at $40. Remember that he had watched it run up from 5 to 7 before he acted. When the silver market moves, it really, 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 truly moves. He's asking me, of course, the when question, and I don't have an answer to him. But I suspect that the answer does begin with when, ultimately, rather than if. But again, the near-term advice, if you can use it, for sure, take the tax loss carry forward.
That's a good point. Stephen D52 says, does Rick have any concerns, and this is one of many on this theme, does Rick have any concerns about possible future nationalization of precious metals mines by their respective countries?
Yes, I do. Sadly, mines are always beset by political risk because they're fixed assets. Dunnigan, if you and I owned a freighter, a dry bulk freighter, and one country started being abusive to us, we'd sail the freighter out of port and never go back to that port again. Mm-hmm. Unfortunately, mines are fixed. Mm-hmm. If you believe that government's job, as they see them, is to redistribute, they must first steal before they give. And mines are great things to steal. So yes, I think that's a real concern.
Any jurisdictions that give you the least or the most concern in that regard?
My belief is that political risk comes in all shapes, sizes, and colors. I had a discovery here in California in 1980 that we weren't allowed to put in production until 1992. So we had free cash flow deferred for 12 years in a circumstance where the interest rates were in double digits. The net present value of that to us, to our clients and shareholders, probably exceeded $500 million. So one thing that can happen is that theft can occur not in an outright fashion, but rather on the installment plan through regulation and tax. The truth is that people that look like you and I, Dunnigan, people who grew up in the United States, come to believe that assets that are stolen from us in English by white people, according to the rule of law, are somehow less gone than when they're stolen more efficiently in other places. But it's not the truth. It's not the truth. Unfortunately, political risk exists, and it's a major, major, major risk in mining, and one that you must simply endure.
We have a number of questions about some of physical metals funds versus non-physical metals funds, but specifically Sprott's funds like PSLV. Moody James says, I've been spicing up my portfolio with a dash of PSLV recently, and like other resource funds, I see its price in relation to spot price of the underlying asset has fallen since the fund's inception. Can you talk about the reasons for this divergence in price? Does this make it an unwise long-term hold? Please talk about the pros and cons of owning PSLV trust versus owning kilos or other 100-ounce bars in a vaulting facility if the buyer is holding for the intermediate term without taking delivery. Thanks a million, by the way.
The chief attributes of PSLV, and understand that I'm a large shareholder in Sprott, so it's in my interest if you own PSLV. Let's get the conflict out of the way before I start the commercial. The big attributes of PSLV are that for most U.S. taxpayers, there are tax advantages associated with enjoying capital gains as PSLV rather than as physical metal. There are some physical metal holders who believe that reporting is optional. I would encourage them to drop that point of view. It's extremely dangerous. The other advantage that the physical trusts have over physicals, and this has come to my attention later in life, is they're simply more convenient. I can buy and sell the trusts on the New York Stock Exchange with the click of a mouse, rather than having to go to a bullion dealer, pay the markup, move the metal, store the metal, and pay the markdown. There are arguments for both. There are people who believe, and I think it's not an unintelligent point of view, that metal isn't theirs unless it's theirs, unless they can hold it and pet it. Mm-hmm. I would ask your indulgence in one further caution, however. To the extent that you are going to have physical precious metals, find a depository to store it in. Do not store it at home. Midnight gardening exposes you to a whole different set of risks than the risks that you're trying to guard yourself against by holding physical precious metals, which is to say people who would rather that metal was theirs.
Another question related to that from another couple who are interested in asking about PSLV and other physical funds that Sprott has is, are the funds that are invested in there by depositors 100% or what percent put into metals? In other words, what part of the funds are backed by metals?
About 99.5% at last count. It varies a little bit. But we never have any assets other than cash held for deployment and to pay the moderate expenses that the fund endures. We never take deposit receipts. We never take certificated precious metals. We only take physical precious metals. And by the way, when 2 or 3 or 4 weeks ago, when physical precious metals in retail denominations were so scarce, we were able to buy some days as much as $50 million in metal for immediate delivery to the Royal Canadian Mint. It wasn't always easy. Some days we had to buy it in London and have it flown to Canada. But the truth is that even during periods of time when there was no 1-ounce product available on the U.S. market except for in extraordinary premiums, we were able to fill with 400-ounce products. But in answer to the question, the assets of those trusts is in physical precious metals stored at the Royal Canadian Mint.
This one goes into a different territory about cryptos, and Francis Wood asks, having had one too many last Friday night, I texted a question to the neighborhood crypto evangelist. I asked the price of Bitcoin, and he responded, $93.18. I asked if $93.18 was US dollars. He said, yes, US dollars. Then I asked, what is Bitcoin worth when the US dollar is worth 0? Well, there's 2 hours of my life I can't get back. A new question emerges. Are cryptocurrencies money or religion? So your view on the role of cryptos as a store of value in reference to your decades of experience of precious metals as a store of value?
I don't think that they are as yet stores of value because they have no utility other than as a medium of exchange and as a form of privacy. But gold and silver have utility outside their utility as a medium of exchange. They're used in industrial applications and they're used in jewelry. And in truth, the market is much deeper for gold and silver than it is for cryptos, and deeper in every society in the world. What are the utilities, the privacy utilities and the transactional anonymity utility of crypto's worth on an absolute basis. Now, if you happen to be in Venezuela and you wanted to get money out of Venezuela in US currencies, Bitcoin, Ethereum, and other things became extremely useful because you could transfer those savings electronically, and it was beyond the technological capabilities of the Venezuelan government to further enslave you, and that's worth something. I just don't know what it's worth. But I would argue with you that the value proposition of Bitcoin is probably the equivalent of the value proposition of many fiat currencies. It's just that the fiat currencies have broader acceptance and more institutional arrangements for transmission. Ironically, the utility of Bitcoin as a medium of exchange is obviated by its very volatility. When the price of Bitcoin is going up, people are afraid to spend it because they don't know what value they're giving up for the benefit that they're getting. So the very volatility of Bitcoin that attracts speculators reduces its ultimate utility, which is as a medium of exchange and an anonymous medium of exchange. For me personally, given that I've spent 45 years trying to understand gold and silver, and about 18 months, maybe 24 months now, trying to understand Bitcoin, I'm comfortable or more comfortable with the assets I know than the assets I don't.
Back to the idea of, you mentioned storing precious metals and some trade-offs there before. This question from Raymond Garcia says, Rick, what is your opinion of vaulting precious metals offshore in countries like Sweden or Singapore? Do you think that if an international bank meltdown were to occur, it would prevent owners from retrieving their precious metals via either physical delivery or to major currencies like the dollar?
Again, we're talking about probabilities. And my suspicion is that somebody who is as aware of the circumstance as your listener obviously is, will probably see warning signs coming and will be able to retrieve his or her bullion before worse comes to worse. I would also point out that there are non-bank depositories in those places, private depositories like Brinks or others. I'm not advocating any of those alternatives because I don't know enough about your questioner's personal circumstance. But I know some very smart people who have chosen to hold bullion personally outside the political jurisdiction that they live in because they felt that the risk of foreign confiscation was lower than the risk of domestic confiscation, that investors in some countries around the world are viewed as assets rather than chattel, and that the importance of the financial services industry in those countries is such that foreign investors might more reasonably expect to be protected there than here.
We've got a couple questions here related to your outlook. You've already talked about one of these, which is about asset balances, and you've said every time we've had you here, you don't give personalized financial advice in this format, and that's correct, and we don't offer it either. But there are multiple questioners here who are asking, well, what does Rick do? So, I mean, that would be one question is what do you do, but it may not be reflective of what maybe the average viewer could consider doing. But you did go through a quick list there a few minutes back about the order that you think people should take care of business in terms of making sure you got this basis covered before you do this basis and this basis. And I think it started with some ready cash reserve, and then you talked about physical. Can you want to go through that order again?
Sure, and this is going to vary person to person, depending, as an example, on their age, income, job status, things like that. Certainly have at least 3 months living expenses in cash. If you live in the US dollars cash. If it's possible to have 12 months is better than 3 months. Some people, as a consequence, when I say 12 months of the fact that they can't afford it, choose to have no cash whatsoever because they can't have 12 months. If you can't have 3 months, have 1 month, but have cash. The second thing is, and there's no certainty of this, but understanding what they're doing to your cash, have some physical precious metals too, or precious metal surrogates like our trusts. In other words, maintain some liquidity that, while volatile, is good liquidity, which is to say gold and or silver. If, having accomplished those two goals, you have money left over to invest, my suspicion is that the best investment sector that I know about for the next couple of years is likely to be the precious metal stocks. Understand that they will be volatile. They won't go straight up. They'll go up or down. But the most important thing to invest in is yourself, and if you have one, your own business. The truth is that taking the time and spending the money to invest in your own education, in asking yourself these questions, in reading some of the wonderful books that are available on investing, in paying attention to podcasts, investing in yourself is actually a form of wealth that can't be either stolen or directly taxed. It's unusual. It can be lost. In my case, I've lost substantial knowledge over time, but that's my fault.
You've forgotten more than most of us are going to learn, right?
And certainly to the extent that you have your own business, even if it's a side hustle, make sure that that business is adequately capitalized and you invest in yourself. Right after liquidity, investing in yourself and investing in your business is the most important thing you can do, more important than any stocks or bonds you might buy.
Now, this is a different side of what we were just talking about, Kyle Atkinson, because you just mentioned you think we're in for a period of expansion in terms of values of metals and mining. Kyle Atkinson says, could you get Rick's opinion on how long he thinks this bull market in gold will last? I hear many different sides from smart people from 18 months to a whole decade.
No is the answer. But if the questioner will look to the Barron's Gold Mining Index, what he or she will see is that in 8 prior recoveries from oversold bottoms, the up market lasted as briefly as 12 to 13 months and as long as 42 months. And the upside duration varied from as little as 180% to as much as 1,200%. So given that I don't have an honest answer, but I want to try and please the questioner, I would say sometime between 12 and 42 months. And that we will experience upside within the historical bounds, which is to say between 180% and 1,200%, understanding that we have probably, at least in terms of the stocks, used up the first 4 or 5 months of that 12 to 42 months.
Okay. Now, I can't let you get away without asking you to tell us more about the Sprott Natural Resource Symposium that was scheduled to be a physical conference, a premier flagship conference in Vancouver, British Columbia, next month, July. It has changed. It has not gone away. It has changed. Can you tell us about what form it is going to take and what people can do so that they can participate?
That is correct. For almost 30 years, of course, we've put on this wonderful physical conference in Vancouver that I humbly believe is the finest natural resource investment conference in the world. Hundreds of people, by the way, agree with me. Mm-hmm. The consequence this year is that obviously for legal and, in fact, for practical reasons, we can't put 1,000 of our closest friends into a conference room with no social distancing. We've always tried to pack that conference room. That's part of what has made it so much fun. So we're doing it virtually. And I'm of really 2 minds about this. I'm excited about the technology. I'm excited about the fact that, Dunnigan, you don't have to leave where you are, and I don't have to leave where I am. I'm excited about the fact that we've reduced the travel expense, the hospitality expense, the lodging expense, so that we can spend more time on content and more time on technology. I'm a little concerned about the ability that we might have through social media to allow attendees to talk to each other. The informal, organic nature of the discussions that would happen at the coffee pot will be missing. But I'm freed from the tyranny of time and real estate in the sense that one of the most frequent criticisms I got of the conference in years past was bittersweet, which is to say that we gave people too much content, that if we had 6 workshops simultaneously, that they wanted to attend 3 of them, and that wasn't possible. Well, now you can. You can, in fact, toggle back and forth between them on your computer, or you can store them and watch them one at a time. So being free of the tyranny of content and the tyranny of time, I think is very, very useful. We will be able to have more headline speakers simply because we don't have the same time constraint in the conference. And we're taking full advantage of that, believe me. Let me tell you one other thing. If people want to take a risk with me, we've slashed the price of the conference, of course. But if people want to take a risk with me and they want to pay for the conference and see how they like it or not, if somebody doesn't think they got their money's worth, all they have to do afterwards is email me personally, rule at sprottglobal.com, and I'll refund the money. I believe that we're going to put on a hell of a conference. It's going to be a different conference. It's going to feel differently, but the attributes of the conference, which is to say exhibitors that are owned in Sprott accounts, not chosen because they had the ability to write a check. Opinion leaders whose opinions matter to us. All of that will be in place. And in some senses, it will be amplified by technology. I'm willing to take a chance, and by the way, it's a several $100,000 chance, to the extent that your listeners are willing to risk a bit of time and substantially less money. I'll take the money part of the risk out of it. If you don't believe you got your money's worth, email me. I'll give you a refund, personally.
Well, I've got a sneak peek of the platform on which this is going to be hosted yesterday from one of your conference organizers, and I was impressed with the breadth of venues that people are going to be able to visit there, the main stage, the exhibit hall, the individual exhibitors' booths, and so on. And it's going to be very action-packed, it seems, and the ability to then go back and recap and take advantage of speakers that you missed because you were off looking at another one while it was live, that sort of thing, is going to be a real benefit. So I'm excited because I'll be participating as part of the Miles Franklin team there, and look forward to seeing as many of you who can join us there, because it's going to be a real amazing lineup of speakers on the main stage and a lot of influential exhibitors in the hall, all of which have been personally selected by Sprott. So look for seeing you guys there at the Sprott Natural Resource Symposium, and there'll be a link to that in the description of this video so you can get registered and at no risk financially, because Rick's got your back. So Rick Rule, CEO of Sprott Asset Management, thank you for joining us again, this time on Liberty and Finance and Reluctant Preppers.
Thank you again. And for those who are waiting or about to be waiting for your portfolio, please be patient. I'm, after this interview, going to return to doing that. So I look forward to being of use.
Thanks, Rick.
Thank you.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.
The British are coming! No, not those. The British are coming! No, not those. The British are coming!
No. 1 ounce silver Britannia coins from the Royal Mint at only $2.99 over spot. Spot. It makes me want tea.
Yep, that's them. 1 ounce silver Britannia coins are only $2.99 over spot, now through Sunday, June 28th, 11:59 p.m. Eastern Time. Email libertyandfinance@protonmail.com and include your phone number for faster response.